We often believe that investing is a purely rational endeavor, a matter of crunching numbers, analyzing charts, and making logical choices. We imagine ourselves as detached strategists, meticulously building wealth based on data and foresight. But what if the most significant force shaping your investment decisions isn't the market at all, but the intricate, often unseen, architecture of your own mind? What if your greatest enemy in the pursuit of financial mastery isn't external volatility, but an internal architect we're not even aware of? As Benjamin Graham, the father of value investing, so wisely observed, the investor's chief problem, and even his worst enemy, is likely to be himself. This isn't a mere platitude. It's a profound truth at the heart of behavioral finance. It speaks to how our deeply ingrained psychological tendencies, our cognitive and emotional biases, can act as silent saboteurs, subtly but powerfully steering our portfolios off course. We think we're navigating by the stars of reason, but often we're being swayed by invisible currents, leading us away from our intended destination of sustainable wealth. Consider this for a moment. Imagine a ship's captain, armed with the most advanced navigational tools, yet choosing to ignore the compass, instead relying on the fleeting whims of the ocean currents. This is akin to how we might approach investing when we fail to acknowledge and account for our inherent biases. We possess the data, the knowledge, the ambition, but if we don't understand the internal forces at play, we risk drifting into treacherous waters, making decisions that undermine our long-term financial health. This is precisely why we're here today. This video is dedicated to uncovering these unseen architects of your investment decisions. We will delve into the core of behavioral finance, revealing how our psychology, not just market data, dictates our outcomes. We're not just going to talk about biases in the abstract. We're going to shine a light on the top 3 behavioral biases that are most likely sabotaging your portfolio right now. Biases that you might very well be ignoring. By understanding their real-world impact, we can begin to build robust defenses, fortifying your strategy not just against market fluctuations, but against yourself. This is about gaining the clarity and control needed for true, sustainable wealth accumulation. Let's pull back the curtain on the first, and perhaps most insidious, of these behavioral saboteurs: confirmation bias. This is our innate tendency to favor information that aligns with what we already believe. We actively seek out data that confirms our pre-existing notions, interpret new information in a way that supports our current views, and more readily recall evidence that validates our existing opinions, all while conveniently overlooking or dismissing anything that challenges them. Think about the investor who is convinced a particular stock is destined for greatness. They will passionately scour the financial news, seeking out only the most optimistic analyst reports, the most glowing company press releases, and the most bullish commentary. Any piece of information that suggests a contrary view, a warning about market saturation, a hint of management missteps, or a concerning economic indicator is easily brushed aside. It's dismissed as mere noise, a short-term fluctuation, or the ramblings of the perpetually pessimistic. This isn't objective research, it's a self-reinforcing echo chamber. When we say, "I do my own research," we must ask ourselves, am I truly seeking truth, or am I just looking for data that validates what I already want to believe? It's like a doctor who, having settled on an initial diagnosis, then proceeds to look only for symptoms that confirm that specific illness, inadvertently missing critical signs that point to a completely different and perhaps more dangerous condition. To defend against this siren song, we must adopt a deliberate counter-strategy. I call it the devil's advocate technique. For every investment thesis you hold, for every conviction you have, you must actively and rigorously seek out the strongest, most compelling arguments asterisk against asterisk it. Don't just glance at them. Immerse yourself in them. Construct a pre-mortem analysis for your key holdings. Imagine, a year from now, that this investment has failed spectacularly. What were the most likely reasons why? Ignoring confirmation bias comes at a steep price. It means missing crucial sell signals, locking in losses, or failing to capture gains. It leads to over-allocating capital to flawed ideas simply because we haven't allowed ourselves to see the flaws. It perpetuates poor investment decisions, trapping us in a cycle of self-validation that can devastate a portfolio over time. Next, we confront anchoring bias, a psychological phenomenon where we become fixated on the first piece of information we encounter, using it as an anchor to which all subsequent judgments are tethered, regardless of its relevance or accuracy. In the realm of investing, this often manifests as an unhealthy obsession with past prices. Consider the investor who purchased a stock at $100 per share. When the market shifts and the stock price plummets to $50, they find themselves paralyzed. The $100, the initial purchase price, becomes an immutable anchor. They cling to it, believing it represents the true or fair value, even as the underlying fundamentals of the company may have deteriorated or broader market conditions have fundamentally changed. They are like a mariner refusing to abandon a sinking ship simply because they they paid a substantial sum for the initial ticket, ignoring the obvious reality of their predicament. This often leads to a misinterpretation of the timeless advice to buy low, sell high. Anchoring can prevent us from recognizing when a current low is actually a fair or even elevated price based on updated information, or conversely, when a past high was an unsustainable anomaly. The anchor becomes a distortion, preventing an objective assessment of the asset's current intrinsic value and future potential. To defend against this powerful anchor, we must consciously shift our focus. Rather than dwelling on historical prices, we must anchor our decisions to intrinsic value and the concept of opportunity cost. This means rigorously and regularly re-evaluating our investment thesis. Every holding should be assessed anew based on current market conditions, the company's latest financial reports, its competitive landscape, and its forward-looking prospects. A critical question to ask is, if I had this capital today, with all the information I now possess, would I still choose to invest it in this particular asset at its current price? The cost of ignoring anchoring bias is profound. It leads to the painful act of holding on to losing investments long after they should have been divested, tying up capital that could be far more productively deployed elsewhere. It allows arbitrary, past price points to dictate future financial decisions, preventing us from adapting to new realities and ultimately hindering our progress towards sustainable wealth accumulation. We now turn to the third, and perhaps most emotionally charged, bias that can derail your financial journey: loss aversion. This principle, a cornerstone of behavioral economics, posits that the psychological pain of losing money is a far more potent force than the pleasure derived from gaining an equivalent amount. Simply put, we feel the sting of a loss about twice as intensely as we feel the joy of a win. This powerful aversion to loss often leads investors to adopt counterproductive strategies. They might be quick to sell their winning stocks, eager to lock in those gains, driven by a fear that the market might turn and erase their profits. Simultaneously, they cling stubbornly to their losing investments, enduring the pain of a declining portfolio, all in the desperate hope that the investment will eventually recover, thereby avoiding the finality of realizing a loss. It's akin to eagerly giving away your winning lottery tickets, fearing they might become worthless, while simultaneously buying more losing scratch-offs, clinging to the faint hope of breaking even. The classic investment advice is to cut your losses short and let your winners run, yet loss aversion makes this directive incredibly challenging to follow in practice. Our emotional wiring compels us to do the exact opposite. We cut our winners short and let our losers run. This emotional imperative directly contradicts the rational behavior needed for optimal portfolio performance. To build a defense against this pervasive bias, a robust risk management plan is essential. This plan must include predefined stop-loss points, established asterisk before asterisk you even enter an investment, acting as predetermined exit points that remove emotion from critical decisions. Frame your investment decisions not around the fear of regret or the pain of loss, but around the concept of expected value. Consider the powerful, almost magical, long-term compounding impact of allowing your well-chosen winners to grow unfettered. The cost of ignoring loss aversion is a consistently suboptimal portfolio performance. It's a drag on long-term wealth accumulation, as winners are prematurely exited and losers are held for too long. Both actions actively hindering the power of compounding and preventing your capital from reaching its full potential. We've explored three powerful behavioral biases: confirmation bias, anchoring bias, and loss aversion. Now, let's understand how these forces don't operate in isolation, but rather converge, often in concert, to create a veritable perfect storm for poor investment decisions. They are not merely isolated quirks, they form a self-reinforcing cycle that actively undermines the rational analysis and strategic planning so crucial for building wealth. Think of yourself as the captain of a ship tasked with navigating the vast ocean of financial markets towards the shores of sustainable wealth. Confirmation bias is like using a flawed map, one that only highlights routes you already believe are correct, ignoring the vast, uncharted territories of potential danger or opportunity. Anchoring bias is akin to fixating on a specific, perhaps irrelevant, landmark from a previous voyage, refusing to adjust your course as the actual coastline changes, and loss aversion. That's the paralyzing fear of steering away from a known, but perhaps manageable, storm, even when a clear, safer path lies just beyond your current sightline. When these forces combine, the intended destination becomes highly unlikely, if not entirely unreachable. The hidden risk lies precisely in this synergy. Your confirmation bias might lead you to seek information that validates your initial thesis, while anchoring bias keeps you fixated on a past price, and loss aversion prevents you from cutting ties when the evidence suggests you should. This creates a feedback loop where emotional impulses, rather than objective data, drive your actions, systematically eroding your portfolio value over time. What were intended as wealth-building strategies can, therefore, morph into wealth wealth destroyers. To counter this, we need a practical framework for self-awareness. I propose an investment decision audit. After making any significant decision, whether it's buying, selling, or holding an asset, schedule a revisit. First, review your decision a week later, and then again a month later. Ask yourself, with brutal honesty, did your emotions or these inherent biases play a role? Document the process objectively, noting the information you considered and, more importantly, the information you dismissed. This conscious act of reflection and documentation builds a vital defense mechanism. By understanding how these biases work in concert and by implementing simple audits, we can begin to dismantle their destructive power and build a more resilient, rational approach to investing. We've explored the psychological forces that can sabotage our investments, but understanding biases like confirmation, anchoring, and loss aversion is only the first step. The true journey to investment mastery requires moving beyond mere awareness to actively mitigating these influences in real time. This is where practical application becomes our ally. Consider the decision journal before making any significant investment choice. Commit your thought process to paper. What information are you weighing? Which biases might be at play? What are the objective merits of this decision? Then, after the outcome becomes clear, revisit your journal, document the results, and compare them to your initial reasoning. This creates a vital feedback loop, revealing recurring patterns of bias thinking and enabling continuous improvement. It's a method for engineering a more objective perspective on your own actions. Furthermore, the power of systems cannot be ignored. Implementing automated risk management rules, such as trailing stop losses or strict position sizing limits, creates a crucial buffer against emotional decision-making. These systems ensure discipline, protecting your portfolio even when market conditions trigger emotional responses. Think of the scientific method: hypothesis, rigorous testing, objective analysis, and adaptation based on evidence. As investors, we must adopt this same scientific rigor. Our goal is to become scientific investors, approaching every decision with a commitment to data and an openness to revise our thinking, even when it challenges deeply held beliefs. Ultimately, genuine financial mastery is less about picking winning stocks and more about mastering the most complex asset at our disposal, our own mind. By consciously engineering our cognitive architecture and building defenses against our inherent biases, we forge the strongest foundation for navigating market uncertainty and achieving sustainable wealth. We've journeyed through the often hidden landscape of our own minds, uncovering three formidable behavioral biases that can systematically dismantle even the most carefully constructed portfolios. Confirmation bias, the relentless pursuit of validating our existing beliefs. Anchoring bias, the stubborn adherence to arbitrary past prices. And loss aversion, the overwhelming fear of experiencing pain that often dictates irrational decisions. These are not minor quirks or insignificant footnotes in the story of investing. They are powerful, pervasive forces that, when left unchecked, can turn promising strategies into wealth-destroying endeavors. Awareness, as we've established, is indeed the crucial first step. It's like recognizing the storm on the horizon, but a sailor who merely acknowledges the storm without charting a course or preparing their vessel will likely find themselves overwhelmed. Similarly, an investor who understands biases but fails to implement proactive defense mechanisms and disciplined processes risks being capsized by their own psychology. Sustained success in the markets and in building wealth hinges on this active mitigation. Think of a master craftsman. They don't just pick up a hammer, they understand its weight, its balance, its purpose. They have honed their skill through practice, ensuring the tool serves their vision, not the other way around. A successful investor must similarly master their own psychology. It is the most complex and arguably the most valuable tool in their arsenal for navigating the unpredictable currents of the financial markets. Warren Buffett, a titan of investing, once wisely stated, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This profound wisdom extends beyond corporate valuations and into the realm of our own minds. It is infinitely better to possess a fair, even imperfect, understanding of our inherent biases, coupled with a wonderful, robust strategy to manage them, than to harbor a deeply flawed perception of our own rationality while lacking any strategy at all. So, as you move forward, I urge you to take one concrete step. Choose just one defense strategy we've discussed today. Perhaps it's implementing a decision journal, or setting clear stop-loss points, or consciously playing devil's advocate for your next investment idea. Begin to build a more rational, more data-driven approach to your investments. This conscious effort to understand and master your own mind is not just a path to better investment returns. It is the very foundation for navigating market uncertainty and securing your journey towards sustainable, lasting wealth.